Hello, and welcome to the Three Questions Podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. If you or someone close to you are wondering how to navigate the complexities of investing in 2025, stay tuned. Our topic this week, the three questions cross-border investors should ask about investing in 2025. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Podcast, please consider liking this video and subscribing to our podcast and YouTube channels. Joining me on this episode of the Three Questions Podcast is Steve Calley, Chief Investment Officer here at One Capital Management. Steve is the Chairman of One Capital's Investment Committee, and he's also a Chartered Financial Analyst, and he's a member of the Los Angeles Society of Financial Analysts. And what we're going to do today is we're going to explore the three questions cross-border investors should be asking about investing in 2025. Steve, thanks again for making time to join us. Join us here on the podcast. Great to see you again.
Always good to be here. Great to see you, Wayne.
Great to have you. See lots of, I will say this right off the bat. We are not at a loss for topics to cover. And I will say this, we haven't started. I have no idea how long we're going to take, but for those who have just started listening, this is probably going to be one of the longer podcasts we've done. We have a lot to cover. I think we could do the 33 questions podcast today, although we won't do that, but we have a lot of content to cover. And we probably should just start right off the bat here with even before we get to the questions, with the elephant in the room first. And we all know what that is. We have a new administration in place here in the United States. We have a Republican president, President Trump. We have Republicans that would have a majority in the House and the Senate. So putting the question to you, because I know my clients are going to be listening and watching this, how does this dynamic, how does this dynamic impact OCM's investment strategy? What is the investment committee talking about, for 2025 that maybe they weren't talking about last year or the year before?
Well, and the other thing, Wayne, is you have a little bit of a mini elephant in the room with Prime Minister Trudeau stepping aside, and new elections probably coming up in Canada. So it's not just south of the border. We're also seeing it north of the border, and that's going to change the dynamics not only here, but it will change the dynamics there. And depending on who wins and depending on what happens in Canada, it'll probably change the dynamics of some of the things we're going to be talking about, such as tariffs and things like that. So it's not just one elephant, there's two elephants. One might be a little bigger than the other one, but but that's definitely it. So, going to your question about, how does the new administration affect our investments? The simple answer is it doesn't really affect our investments in the sense that we're always analyzing, we're always looking at what's going on. I mean, that's our job, is to continue to monitor situations, try and stay on top of all of those things and make adjustments as needed. So it's not just new administration, it's tax laws, it's regulatory policies. It's even little things such as the fires here. Not little, huge down here, but little things such as the fires in California. And what does that do to the dynamics of not only the local economy, but the national economy as well? So the simple answer is not a lot. The more complex and the more reality of it is, you have to take into account this is a very big change, especially from the past administration. However, as you and I, Wayne, have talked just privately, as back and forth as you come down to my office when we talk, the things that people are probably not capturing, and we can talk about this a little more, is that yes, there's a change. Yes, there's a majority in both the House and the Senate, but there's slim majorities in the House and the Senate. Things don't happen overnight. We have checks and balances. As we've seen with the executive orders that are being signed, they're already being challenged in the courts. There's a lot that has to happen before the things that we hear about and that we see in the news actually come to fruition or don't. Mm-hmm. And so that's where we have to stay on top of things, is not just listen to the hyperbola, not just listen to what people think, but we actually have to see the dynamics and what's going to happen, and we have to plan for different contingencies. So that's why I say the simple answer is it doesn't change a lot because that's what we're always doing. The real answer is Trump's a big deal and it's a big change. And so we're just more on top of the things than we might otherwise be.
I remember one thing, the thing that you reminded me of before, I guess it was right after the election, was that, you know, the fact that the Republicans have a majority, a slim majority, is relevant because, as a general rule, the Democrats will typically vote as a block on large bills, and Republicans are a bit more what's the word? Divided,
A little
splintered,
more fragmented,
a
exactly.
little
A
bit
little
more
more fragmented.
fragmented. So it's not easy to round the herd up on that on the red team to get anything across, get anything passed. So the fact
And,
that
and
if they had a large majority would make a big difference, but where we are now, some of the things that need to go through the House might have a
yeah.
harder time passing.
Well, absolutely, and that that still holds true, and I think they're going to be fragmented. The difference between this election and the last time he was elected is the Republicans were far more fragmented, and there's a whole contingency there that were never Trumpers as they called it. This time, over the last 4 years, the Republican Party has come more in line. So I do think he has a better chance, even with the slim majority this time, than he
Even with
did
the
last
Freedom
time.
Caucus, even with that
Even with
Freedom.
even with the Freedom Caucus, they're hurting those cats a little bit better this time around than they did last time.
Oh, as they say, more shall be revealed. Okay, so Steve, we got to get right to it here. The other elephant, of course, is we have a lot of folks who are listening and watching in Canada, and we have clients here in the United States that have Canadian dollar denominated investment accounts. That big nasty word tariffs coming to the
Yeah.
forefront, and we're hearing a lot. Man, there's a lot of people pounding their keyboards on this topic in both countries. Wall Street Journal had a big article about it yesterday. A couple actually read an article this morning in the National Post. It was almost like an essay on all of this. I have clients emailing me of obviously saying, how does this affect our investment accounts? 35,000 foot level here at this point. What's your initial take on all of this?
The initial take is that there's a lot of bluster, there's a lot of talk, there's a lot of postulation, there's a lot of speculation of what's going to happen. Interestingly enough, with the executive orders that he signed the first couple of days here, tariffs are not included in any of those.
Yes.
That's a real positive sign for those that are concerned about the tariffs. They're coming. Don't get me wrong, they're coming. He's using them, especially in Canada and Mexico, the threat of a 25% tariff. And, I've read some analysis on that. If he actually instituted a 25% tariff against the Canadian imports, that's recession time for Canada. I don't think we're getting there. If you were to ask me my opinion, I don't think we get there. I think it's just a big stick trying to get the Canadians and the Mexicans to come to the table, really negotiate the U.S. Mexico, Canada Accord. Yeah. So I think it's really a lot about that. If he institutes a 10% across the board to everybody, which is one of the things he's talked about, which includes everybody in the world, it hurts the Canadian economy, but it doesn't put us into a recession. It just slows some things down. At the end of the day, it's too early to tell. It's too early to say. I can tell you what I think. I can tell you where I think it's going. I don't think it's going to be the really onerous. I don't think it's going to push the economy into a recession in Canada. I don't think any of that's going to happen. But even a little bit of tariffs on Canada will probably weaken the currency a little bit. And we've talked a little bit privately, you and I, about currency. And I do think that would, and that actually, as interesting as is, if the tariffs go into place and the Canadian dollar weakens, it actually offsets the effect of it to both countries. U.S. consumers won't be paying more because the U.S. dollar is worth more in Canadian dollar. Canadians will still be selling at the same because it's, like I said, it's an interesting thing that if the currency right now, as a matter of fact, today, because the currency's already moved about 5% in Canada, a 10% tariff would only affect the Canadians' marketplace by 5% of that. So it's a relatively small piece that would happen. So again, A 10% tariff would probably be, this is my thinking, probably short term. I don't think he wants to punish Canada. Canada's our biggest trading partner, and they're super important to us, and we're important to them. It's interesting because a lot of the goods that go across the border, Canadians exporting to the US are stuff we sent to you in the first place. You worked on it and then sent it right back to us. And so, like I said,
We send you raw materials that you've worked on and send it back to us.
exactly.
Us being a Canadian, this is me with putting my Canadian hat on here.
Right. So there's such a symbiotic relationship there that it's not in any ways interested to be adversarial in that sense. Now, again, as I mentioned, the small elephant in the room, the Trudeau administration and the Trump administration would butt heads.
Yeah,
we're not going to have that. It's actually, it doesn't matter who gets elected, conservative or liberal in Canada, it's going to be a better relationship than it would have been had Trudeau not stepped aside. That's just the way it is.
I think there's a perception thing where the president is saying that the U.S. is subsidizing the Canada because of the difference between in exports.
There's
that's a bit of, and that's I read an article about that today, and on the Canadian side, and they take quite a lot of offense to that perception.
As they should.
Yeah.
And again, there's really three things that he's worried about. It's the deficit. So Canadians are in a surplus to the U.S.
Right.
He'd like that to balance out a little bit. Again, that's neither here nor there because capitalism and wherever the best product is should be. That's what you're supposed to do. I mean, if we're buying more from Canada, that means Canadians are producing more that we want, and that's a good thing. The other thing is he really does want to stop the immigration. Again, it's more of a southern border, but there's still some in the northern border.
And also the fentanyl is also.
Yeah, the fentanyl is coming across both sides
because his way of saber rattling to.
Exactly. And the third piece is he doesn't think the Canadians are spending enough on defense.
And he's not wrong.
Because they can rely on the United States for a defensive pact on that. And I read a piece and somebody said, the next administration up in Canada could wipe all that out by spending more on their military by buying U.S. goods like that. Like in one fell swoop, you
kill two birds with one stone. You increase your military and increase your imports at the same time.
And you now have more, capability of monitoring the border. Like I said, it can be a win. That's why I'm not as concerned today. We need to monitor it. Like I said, you never know what's going to happen. Need to monitor, but I don't look at it as a long-term real negative because I just don't think the 25. That's his big stick to negotiate. That's who he is. That's what he does. And the 10% will probably come off shortly thereafter as they work out some agreements and. Increased spending and buying some U.S. military hardware and things like that.
Okay, well, we're just getting started here. I know we're going to talk a bit more about portfolio management here in a moment. So,
those are part of the 33. Those are part of the 33 questions you were going to ask.
Right. Yeah, we're almost there. Almost, it seems. Yeah, I read an article in the Wall Street Journal last night just before I shut things down and. For the night, and the comment was that it would appear that they want to get the USMCA negotiations started early.
Yeah.
And, what's really in play on that, apparently, from what I read, and again, I guess the Wall Street Journal is a fairly reliable source, was the auto agreement was a part that they seem to be very eager to address, which.
And it's interesting because that piece of it, while Canada and the U.S. trade quite a bit back and forth because Detroit's right there, that piece is really more focused on the Mexican side of things. He's more worried about the auto side in Mexico than he is in Canada. I mean, it all comes together. But the USMCA has to be. I mean, the negotiation is going to take place in 2026. With or without a change, he's just trying to push. Yeah, he just wants to push it ahead a year. Yeah.
All right. So enough on tariffs for now. We solved nothing, but I hope we gave our listeners, our clients, a little bit of a sense of ease here on that note for now, at least. And again, more shall be determined here. So on another episode that we did last year, Steve, we discussed the benefits and the risks of owning Bitcoin ETFs. I'm sure you remember that episode. I will note that, President Trump is taking a lot more of a favorable stance on crypto ownership in general than, the Biden administration. Gary Gensler, head of the SEC, not really crypto friendly, say the least.
Yeah.
So does the president's view on crypto change how One Capital will approach including crypto in our clients' investment strategies going forward? Because currently we have no exposure.
Right.
And so your thoughts? We haven't even got to the 3 questions yet, by the way. We're just priming the pump here.
Exactly. On the crypto side of things, the answer, well, crypto is complex, as we talked about in our meeting, and there's a lot to that. And I would refer people back to that episode as well, because there's a lot of good topics that we talked about that. It doesn't affect how we think about cryptocurrency. Again, the concerns we had before are still valid. The notion that it's going to be a more friendly environment to crypto, that's probably a given. That's what Trump has talked about. It's the people he's putting in place. But the value of crypto hasn't changed just because somebody likes it versus somebody who doesn't like it. I'm a free market guy, and I have a tiny bit of libertarian bent to me, which is what I like about Bitcoin, as we talked about last time. But at the same time, I'm very pragmatic, and it's not. Again, that value proposition is not there for me and not there for us, because what do you have at the end of the day? You've got this algorithm, which is a Bitcoin or a Ethereum or one of these other cryptocurrencies, and there's not a store of value. There's not a fiat currency behind it. As we talked about currency, typically what you want with a currency, and we talked a little bit about with the Canadian currency and versus the US dollar, is you actually want stability, so that a dollar US is worth $1.40 Canadian today. But you don't want that $1.40 to go to 2 or to go to 90 and bounce all over the place, because then all of a sudden it's very difficult to do trade when the prices are bouncing around like that. So as a currency, it's not a great store of value. Where people are using it is, again, a hedge against uncertainty, a hedge against governments, and a hedge against fiat currencies, because we're running a massive deficit in this country. We've got, like you said, I get why people are nervous about the US dollar, and other, again, what's happening in Europe, what's happening in Russia, what's happening. I get why cryptocurrencies have an appeal to a lot of people, because you're outside of that realm. You're less exposed to the volatility of governments and regulatory agencies and things like that. But as a true store of value, as us as investors, it's not there for me. It's a speculative instrument, and it's a hedge against other things that we're not, putting in our portfolio at this point. Again, again, if I suggest they go back to that podcast, because how you buy crypto is you buy the actual crypto, or do you buy an ETF? And remember, an ETF, you're not owning the crypto, you're owning somebody else who's putting a basket of them together, and it's just like a lot of hard asset ETFs. What's behind the crypto ETF? Is it really crypto, or is it futures and options on those cryptos? And then if you do go into the crypto market yourself, if you're buying less than a single coin, you're actually having to go to a third party to buy a partial. So somebody else owns the coin, splits it up for you, and sells you a partial. So you've always got a middleman in between there. So crypto gets pretty complex and pretty complicated, and like I said, it's not a market I want to be in, because it just adds a layer of complexity that we don't need in the portfolio, because it's not serving us what we're trying to do. Because again, the store of value, which I don't see I don't have the attraction to it that so many others do.
Well, I think the term that you use, I think, is from my sort of stance is you use the term speculative, and that's my take on it. And I'm sure there are advocates that have a different point of view, and they're
Right.
certainly entitled to that. But for the type of portfolio management service that we provide, I think we'd be just adding a speculative element to the portfolio, at least at this point in time. Time
Correct.
passes and things change, Steve, and
Yep.
we could be sitting here 5 years from now going, we need to have a 2, 3, 4, 5% exposure because how the circumstances change. But I think at this point, it's purely speculative. And whenever a client comes to me and asks me, what I think about it at the high level, I say, well, if you want to put 10, 15, $20,000 into into some kind of crypto, go ahead. But be prepared. It could double, triple, or it could go to zero. I mean, you have to be prepared for all possible outcomes.
Right. And that's what we talked about as a matter of fact, last time. I agree with you there 100%. Again, one of the things, and you actually hit it, 3, 4, 5 years down the road, as it develops, as things do, as investments develop, as stability comes into it and it works itself out, maybe we do add it. But one of the things I'm notorious for around here is being slow, because I like things that work, and they always work. I don't like things. One of my sayings is, I don't want something that's going to work until it doesn't work, because I don't want to be holding it when it doesn't work.
Yeah. I think another term you use is the greater fool theory. I think that's one I've heard that one bounced around the office more than once. Okay, Steve, guess what? We finally made it to the segment
Three
of the
questions.
actual 3 questions here. And these are the 3 questions cross-border investors should ask about investing in 2025. I say cross-border because we're talking to both Canadian domiciled and US domiciled investors. And in our case, Steve, we're unique. One Capital is really unique in that we have the ability to trade securities in both Canada and the US, and in both US and Canadian dollars in both countries. So definitely cross-border. So here we go. Question number 1 for my friend Steve Calley. Question number 1. Are US large cap stocks overvalued? And if so, is it time to take some profits? And if so, will the rebalancing approach differ for qualified versus non-qualified portfolios in the US and registered and non-registered accounts in Canada? I know it's a mouthful, but the floor is yours.
So we'll start with the overvalued, undervalued thing. One of the ways people value stocks is a price to earnings ratio. So it's the price versus, it's how many multiples of the earnings does a company have. So if a company earns $1 and the stock is trading at 20, that means it's trading at 20 times that dollar that it's earning. That's what a price to earnings multiple is. Historically, and I'll use the S&P 500 as our benchmark and as our proxy. Historically, for the last 5 years, the S&P 500 has traded right around 20 times earnings. If you take that back a little bit longer and you go 15 years versus the last 5 years, that number is more like 17.5 to 18 times earnings. Currently, the S&P 500 is trading at about 26 times earnings. So when you look at that, you say, oh, it's up there. The valuations are higher than the norm or the average over the last 5 years. But it's not outside of, we talk in standard deviations and statistics. It's not outside of the norm. It's at the higher end, but it is not outside of the normal valuation ratio. It's just at the high end. But here's where, and I think we talked about this in one of our other podcasts, the Magnificent Seven stocks that have been really the great performers, NVIDIA, Microsoft, Amazon, those companies that have done really well. If you take those 7 stocks out of the S&P 500,
that changes that equation significantly on valuation.
It goes from 26 times to 20 times earnings, because those 7 on average are running around 38 times earnings. So you can see how they have, and there's reasons why stocks trade at higher multiples than others. You've got higher growth rates. You got prospective, new customers. There's lots of reasons why a company trades at either 10 times earnings or 30 times earnings. So I'm not saying that they're out of bounds either because they're high, but on average, so you take those out And all of a sudden the S&P 500 is right back to where it should be. Well, I shouldn't say should be, then that they average over the last 5 years at 20 times earnings. So it's not as overvalued as it might at first blush appear. That said, no, lots of stocks have done really well. I think we own 6 of the 7 stocks.
That's exactly what I was going to say. You took the words out of my mouth. We own 6
So
of the
we own
7.
6 of 7. The only company we don't own is Tesla. But everyone else we own within that magnificent 7. So some of those have run, and we were early, as we've talked about on another episode. We were early with NVIDIA, so we've got just massive gains in NVIDIA. So the answer is, should we take some profits? We do on a regular basis. That's part of our rebalancing process, where we're trimming off the winners, looking for opportunity, for that money to go in. It's the old adage of buy low, sell high. So when the run stocks run, you take a little off the top, you're actually selling high, and you're looking for where the value is now, and it's usually buying low. So that's what our rebalances are doing. Now, we're not to the point where we would take a massive restructure or really cut our holdings. If we did, and it actually kind of is the second part of your question, would it be different for registered versus non-registered, qualified versus non-qualified accounts? It's actually a great question, and it's one that we've discussed many times here, internally at One Capital Management with our portfolio managers. Because if you've got, and I'll use NVIDIA as an example, only because everybody loves it.
So it's the most incredible growth story.
Exactly.
I think we started off at what? We started off at like 0.5% overall.
Yeah, and it's
like 2.5 or something.
Yeah, it's up there in some accounts, and we've got, on the high end, we've got 2,000-3,000% gains in this stock. So it's a huge gainer. So now here's where a registered versus non-registered, or a qualified versus non-qualified, you might have a little bit difference in your strategies, because when you've got a big gain like that, it's going to be all capital gains. It's 20% in the US. It's half the rate of your ordinary income in Canada. So you've got a favorable rate for capital gains. But if you think about it, I mean, in the NVIDIA case, you're going to basic is 100%. So you've 100% gain on that. So if you sell $100, it's mostly all taxable at that point. So if the stock's trading at 100, and it's not, it's trading much higher than that, but if it was trading at 100, because of taxes, it would have to drop below 80 for you to have made a good trade. So if the stock goes from 100 to 90, which is a 10% loss, and then rebounds, you're better off holding it in a taxable account. In a non-taxable account where taxes don't matter, you can be a little bit more aggressive on those trades. So it's actually a great question, and most people don't ask that because they only think about, well, do we trim stocks? The answer is we will, and we are more aggressive on the trading side of things, trimming on those non-registered, or the registered or the qualified accounts, because there's no tax consequence immediately. It's down the road. So you can be a little bit more aggressive at realizing gains there because there's no tax consequence to it. If it's in a taxable account, we look at what is the difference between, and I use NVIDIA because, again, the gain is so large that the stock has to drop over 20% to break even on your trade. Now, another company that had 100% gain, now you only have 50% of it that's taxable. So if it drops 10%, you've got a break even trade. So you can see how it depends on the size of the capital gain, whether you're going to change how you trim or not. So again, I'm not saying we're in for a 20% correction or even a 10% correction. If we were, that conversation would actually come into play. Where do we trim? How do we trim? What do we do?
Guess we'll have to keep an eye on what's going on over in Taiwan, eh, Steve?
Exactly.
That could be an interesting story. Okay, thank you for getting that one cleared up. Question number 2, and I'll just say right off the bat, one of the things I really appreciate my clients is, they pay attention. And in one particular client review meeting I had at the end of last year, pointed out to me, before I get a chance to point out to him, about how overall small and microcap stocks seem to have underperformed in 2024. And I was suitably impressed that he was following along as closely as he was. So With that being the case, what is the strategy um, for for the micro and small caps? And also, I'm going to throw a second part into that. What role do you see alternative investments play in 2025? And add onto that, not just here in the US, but also for clients in Canada now. How do you see all of this unfolding?
So your client was very astute.
Yes,
Small cap.
that was a good one. That was an eyebrow raiser, like somebody actually paying attention to the minutia.
To the components of the investment portfolio. And again, one of the things that I want to talk about first is the reason that you own multiple asset classes and sizes and things is for diversification, because you want low correlated assets, meaning they don't move at the same time. So owning something that underperforms is not necessarily a bad thing, as long as it's going to at some point outperform so that you get the benefits of the diversification. So the reason that you own different stocks, you don't own just large cap US growth stocks, which have been the top performer, is because they do have corrections and sometimes they're not the top performer. So that's what diversification is all about. It's spreading the risk and having assets that don't move at the same time. So you want to have assets, again, having a piece of your portfolio that doesn't perform as well as another piece, that's okay, because that's part of diversification, because at some point they'll reverse positions.
Reversion to the mean, I think, is the term that we've used, right, Steve?
Exactly. There'll be a reversion to the mean, and so you'll make that up, and over time that diversification gives you a smoother ride and a less bumps in the road, if you will, less volatility. So when the market goes down 20%, you don't go down quite as much. When the market goes up 20%, you're not going to go up quite as much as well. But because you smooth that ride out at the long run, you actually have a better total return.
Outcome, yeah.
So I wanted to put that in there first, because there's a reason why you own these things. Now, it's a great question, because one of the things that we did in this last year is we pulled the microcap out of our portfolios and we sold them out across the board, because those companies, long answer, because what's happening is companies are staying, and it actually goes to your second part of this question with where does private equity come into play? The small companies, historically, the way a company would raise capital is you'd build something in your basement, you'd go to your friends and neighbors, you'd ask for money, they'd help fund it, and then you get to a certain size and you just needed capital to grow your company. So you would go to the public markets, the capital markets, and you would do an initial public offering, and you'd offer those shares to the public. We'd buy them in the initial public offerings, and then a slew of cash would come into the company, and they would be then able to grow. And again, going back 20, 30 years, that's the way things worked, regularly. And 70% of those companies failed. But it was part of the mechanism of getting capital into the hands of entrepreneurs that were building new companies and things like that. Well, the world has changed over the last 20 years, where there's so much more private capital available that you don't have to publicly issue your stock. And on top of that, the regulatory environment has gotten way more onerous. So if I'm a company starting out, I don't want to be public, because I don't want to be under the scrutiny of the SEC, of the FTC, of the, like I said, the regulation has gotten so expensive for these public companies that it's hard to do that. So they're staying private far longer. So what's happening with the small cap and the micro cap companies that are public, and it's not a knock on all of them, but there's a lot of them that aren't very profitable. They got there, they're just not doing very well, and that's why they've underperformed, because so many of those companies are now private, and so
they're just staying private longer.
They're staying private. They're staying private longer. It used to be that they stayed private for about 6 or 7 years. Now they're staying private for 11 to 14 years. You can see that's
and their market cap and their value. I mean, back in 1990, the typical company that went public was like 450 billion, or 400,
Oh, it was about
450
450
million,
million. Now it's
450 million, pardon me. And
now it's
now, I mean, they
multi-billions.
closer to 2.5 billion before they go public.
Exactly,
Right.
exactly. So that has changed the nature. And so one of the things we're doing at One Capital is, again, we took the microcap out this last year. On the small mid cap size, we're actually in the process of launching a more actively managed ETF that we'll be using in the portfolios. That's going to be coming shortly. Uh, so that we're going from a more passive approach, which is what we've done. We just were using the indexes before in the small and mid cap size, and we're going to become a little bit more active. We're going to have active management actually selecting companies, and that way we can weed out a lot of these unprofitable companies that are just in the index. So we're making some changes at One Capital that will add active management to that so that we can weed out the companies that we don't want that aren't profitable. That will be coming shortly. The reason it's been a little bit slow in coming and is because we can do what's called a 351 exchange, where we can exchange existing holdings that have capital gains into the new ETF without having to realize any capital gains.
Okay, I have a question, just a follow-up. Now, we're going to talk about alternatives. Now, we've
Yep.
added alternatives. Now, this is a solution that's accredited investors are eligible to invest in. And as a rule, accredited investors is a individual who has, I guess, an income of over $250,000 a year or $1 million plus of liquid assets, or I think it's
It's $1 million excluding their home. So $1 million of
excluding
assets,
liquid assets, liquid
Yeah.
assets,
Yeah.
or I think it's for a couple it could be 350,
Yeah.
and say they $1 million of liquid assets. Now, this has already been in place here in the U.S.
We've added it. We've added to the US. So that's the other side of the microcap that we took out. The reason we took the microcap out is because we added the private equity. Those
Right.
companies that are staying private longer, we still wanted to participate in because that's where there's a lot of growth coming. In the private equity fund that we brought out, it has private equity, it has private credit, and it has some private infrastructure all within that. It's a
Some
fund
real
of fund.
estate.
Exactly.
So is this
That
something we're going to
is,
be adding? Is this something we're going to be adding to our Canadian
yes.
client accounts?
Yeah, we're just finishing up the negotiations to open it up to Canada. It'll be the same qualified investors that qualify for it. It should be. We're just finishing up the regulatory and the filing fees. We just were negotiating a few things with them, so that is imminent. It's coming soon. We'll be able to add that to the portfolios for the Canadian domiciled investments as well. So we've
Perfect.
got it for the U.S. domiciled. We'll be adding it to the Canadian domiciled investment shortly.
I'm going to really go out on a limb here, Steve, and probably put you on the spot, and you're completely off the hook here if you can't confirm. But I was just curious. As you know, we have clients in Canada with a Canadian custodian that have U.S. dollar investment portfolios. Will that small cap ETF you've been talking about be eligible in those Canadian portfolios?
Yes.
U.S.
Yes.
dollar
So
Canadian.
it will be a U.S. Actually, both of them, the private equity fund and the small mid cap will be U.S. dollar. We will be able to, again, we'll be able to hedge some of that if we need to, because again, we'll talk a little bit about currencies later.
Yeah, we're going to get to that. That's coming up next.
Yeah, exactly. Part of our process is also to, make sure that, we don't overload U.S. dollar for Canadian investors. Right now it's a great thing. It's been fantastic for us the last couple of years. At some point, reversion to the mean, right?
Yeah.
Reversion to the mean, the Canadian dollar's got to strengthen at some point. Not today, probably not tomorrow, but at some point the Canadian dollar will strengthen again.
I am telling you, I remember well. I was back in my days in Canada with my back at IPC days. Our portfolio models were 20% Canadian, 20% US, 20% international equity side, right?
Yeah.
For a 60-40 portfolio. And this one particular year, the Canadian dollar went through the roof. That year, the S&P 500 did 14%. And, or pardon me, I'll stand corrected, did 7%. Our U.S. equity portfolios did 7%. And the return that year negative 7%
Yeah.
because of the Forex.
Yeah.
So I know exactly what you're talking about. So adding a hedge on would have solved that issue. And
Yeah.
so that's anyway, we'll get to that in a second.
I know that very well because we were really just starting our Canadian investments at the time, and there were some opportunities that I fortunately did not take. There was a big spread between U.S. Interest rates and Canadian interest rates at the time, and had we gone U.S. denominated interest rate investments, oh, it would have been we never would have got off the ground in Canada.
Unpleasant.
So currency is something that you have to pay attention to. So these are going to be U.S. dollar denominated investments, but we will have the ability to put hedges on them if we need to,
Okay.
and when the time is right.
Steve, excellent. Great job. Steve Calley's with us. He's the Chief Investment Officer here at One Capital Management, and we're answering the 3 questions cross-border investors should ask about investing in 2025. It's not, I don't know, I guess you could say in a way it's usual, but a bit of an unusual year, lots going on. So we're going to get to our third and final question here, Steve. What is having the most impact on the Canadian equity market, on Canadian equity investors? Is it the lower Canadian dollar? Last I checked, it was below 70 cents US, hovering somewhere around 69.6 cents the last I checked. Is it the lower Canadian dollar? Is it the lack of investment opportunities? And I have a follow-up question on that, but we'll get to that question at sort of a sub question. But let's first talk
3B.
about, let's get to the first part of this, and then I'm going to come back and hit you with another one here before you wrap up.
Okay. Well, I'll give you the super simple answer, and that is yes.
All of the above?
All of the above, yes. Yeah. So the weak Canadian dollar, and part of that is not necessarily Canada's fault. It's just that the U.S. market has been stronger. The U.S. dollar has been stronger. The threat of tariffs has pushed the U.S. dollar up. So that U.S. dollar strength is not a negative to Canada, nor is it a negative to the Canadian dollar, because historically, where, with oil prices where they are, with the energy exports that are coming down the U.S., the Canadian dollar would be higher. So again, if you just use those two variables, which historically we used to be able to say, oil's doing well, Canadian dollar's doing well. Oil's doing poorly, Canadian dollar. It used to be very simple that way.
We had a petrodollar.
We don't have that anymore, and so,
or at least for now.
Exactly, at least for now. And so that weak Canadian dollar is not helping, because historically it would be a little bit stronger today than it is. You've got Trump coming in, which again strengthens the U.S. dollar based on multiple things, and then you have a very strong U.S. economy relative to the rest of the world. Again, strong is a relative term because in Europe the economies are they're eking along. In Canada, Canada really flattened out, and their economy was fairly flat for a big part of last year, and it's now picking back up, but it's growing at about 1% based on the last quarterly numbers. So the Canadian economy has, it's slower. There's not as many opportunities into it. Again, the multinational, the global effect is having there's so many U.S. companies that are buying Canadian companies, or Canadian companies buying U.S. companies. And so there are less investment opportunities in Canada than there were just a few years ago as some of those companies because in Canada, companies have merged, and there really haven't been new companies that have filled the void, if you will, of those companies. And so you're actually having fewer Canadian companies that are investable than we had just even 10 years ago, 15 years ago. So all of the above is happening. And I'm thinking Shoppers Drug Mart and who was the other one that merged with Shoppers Drug Mart? Was it Loblaw and Shoppers that merged?
I will defer to you.
I can't remember. Well, two of the big Canadian, food stores merged, and it became one. When that took out a whole, that one company completely gone out of the investable universe, and nobody filled the gap by having another grocery store come up and take their places. So there's consolidation that's happened in Canada, and it's shrunk the base and the pool of securities that you can buy. So there's actually been an increase in securities in Canada, but it hasn't been new companies. It's been ETFs that have filling in the void. So you're getting more and more ETFs, or you're getting more companies or investment opportunities, but they're just pooled funds, not individual companies. So there's a little bit of that as well that's happening in Canada. You're just losing a little bit of that opportunity to invest in some of those things.
So to follow up with that, I guess the question I know we talked about this again, going back to our somewhat frequent conversations that we ended up having. The thought of potentially, reducing within our client portfolios overall for our Canadian domiciled accounts, the idea of potentially reducing the Canadian equity exposure. Is that something you're seriously considering? What's your thoughts on
Yes.
that?
Yeah, we are, because a lot of the things I just talked about, there's more opportunity other places. And again, like I said, not a knock on Canada or anything else, but there's more growth other places in multinational companies than there are in Canada. So there's a little bit more opportunity outside of Canada. And if you stick with with our full investment, or the amount of investment that we have in Canadian dollar in Canadian companies, we're missing out on some opportunities. So the answer is yes, we're seriously considering shrinking the allocation we have to Canadian large cap companies and increasing our to US and multinationals. What we'll do, and again, this goes back to the currency that we talked about, is when you do that, you expose yourself, like we talked about, that year that you said where the S&P was up 7, but for a Canadian investor, it was -7. I mean, that currency can have that big of an effect. So even though we will do that, and we have the ability to hedge that back. We have the ability to use hedged ETFs. We have the ability to put hedges on ourselves. So the answer is yes, we will probably shrink our Canadian large cap exposure a little bit, increase our US and our multinational a little bit, but we won't sacrifice the currency for that. We'll be very, very mindful of the hedge so that we don't get caught in one of those where the Canadian dollar runs and all of a sudden we have great performance, but we gave it all away because
you get none of the benefit, right?
Exactly. We gave it all the way because the Canadian dollar got stronger.
Okay, I am going to go a little bit deeper into the weeds here. So we have, as you know, many clients that own U.S. domiciled investment accounts in Canada.
Yep.
We have a lower Canadian dollar. Most of these cases, there are exceptions, but most of these cases are IRA accounts, registered. They're qualified accounts. They're people who've lived in the United States for many years, have moved back to Canada. They have these significant amounts in IRAs. For those types of clients, is this an opportunity to start thinking about converting to CAD? In other words, going from our US dollar model strategy, individual positions, to our Canadian model strategy. We can do that. It's one of the great things about One Capital,
Right.
that we can have a US account at a US custodian. We could use a Canadian model there. Is this the time for that, in your opinion?
That's a great question. And if I had a crystal ball that was super clear and I could
You were
tell,
Karnak the Magnificent, Steve?
exactly, then I'd hold the card to my head and I could answer it for you. But that said, the Canadian dollar is really cheap relative to the US dollar. So it's not a bad time to at least start that process. I wouldn't flip 100%. Because I think there's still more opportunity to come. I think with tariffs, I think there's a few things that might, hurt the Canadian dollar relative to the US dollar, might push it down a little bit more. Again, those are short-term events. I wouldn't try and time it because you can't time it. So what I would do is I would say it is a very good time to start that process. I would not flip the portfolio 100% today, but I might start working it that way. Add a little bit in, as we go forward. The macro dynamics still favor the US dollar over the Canadian dollar. The macro dynamics still favor the US market over the Canadian market. So that's where I wouldn't flip it today. We still have a run ahead of us, But at some point, people are going to recognize that, hey, those Canadians are doing it right. And they've got some pretty cool stuff, and they're selling us an awful lot of oil. And that currency is just undervalued. Not today, but it's coming.
Yeah, I think what you just said there last kind of leads me to, pardon the pun, Trump, the decision. And I wouldn't be rushing, given what you just shared there, I wouldn't be rushing out the door to, as you said, flip the portfolio from US to Canadian.
Yeah,
Yeah, maybe.
not
Uh,
yet.
yeah, okay. All right. You mentioned in a minute ago, a couple minutes ago, about US and international. What's your opinion of international large caps?
So here's another thing that we're tweaking in our portfolios at One Capital Management is we've used individual names, and the reason we've done that is because we really care about the quality of the company and the value of the company. So we don't own Toyota, but I'm using Toyota as my example. If I want the best car maker in the world, I want to own Toyota. I don't want to own Ford. I don't want to own GM. Maybe I want to own, Porsche, Audi, and Toyota. So it doesn't matter where they domicile. I want to own those companies because they're selling the best cars in the best places and things like that.
Blasphemy, Steve, blasphemy.
I know, I know.
And guilty is charged, by the way. Anyway, carry on.
So that's what we've expanded, and so our international holdings, we've added more of those global international names. That's why I kept saying multinational versus foreign or international stocks. Is we want, and a lot of those companies are selling 40, 50, 60% of their assets or their products in US dollar anyway. So they may be domiciled someplace else, but a big chunk of it is coming from the US economy or US dollar investments and things like that. But we also have a passive component within that international holdings that we have. That piece we're addressing will probably, again, same thing, we'll probably shrink that, add individual names, whether they're US or multinational names. So we are going to shrink that large cap international a little bit, small cap international a little bit. We'll be taking that weighting down because, again, the future is pointing to a stronger American economy. Again, it's not just America, because remember, the Americans are selling all over the globe. It's like I say, it's the multinational that's happening. They may be domiciled here, but they're selling all over the globe, and we just have a better business environment in the US than there are in a lot of other places. The business environment in Europe is not as favorable as it is in the United States. The business environment in Canada is not as favorable as it is in the United States. It's good, it's just not as favorable. So the future still looks very bright for US domiciled companies that are selling in the US and globally, because it's a very business friendly. And again, with a new president, there's going to be regulatory reform in the US, and that's going to actually just make it, or we expect it to make it stronger and stronger as a domicile for businesses in the United States. So the opportunity is still with US domiciled companies that are selling around the globe. So we're going to take advantage of that and expand that piece of our portfolio by shrinking a little bit on the fringes, some of the other holdings that we have.
So there's going to be, this is the thing, this is in the context of a client that may have a 60% equity portfolio, 40% fixed income. We're not going to change the allocation. We're going to maintain that strategic strategy, but within that, we're kind of like a duck, Steve, very calm on top of the water, lots of paddling underneath.
Yep. That's
okay.
actually that's a great analogy of what we do. What clients see is they see the duck.
They don't see the investment committee smoking out seeing all the sawdust burning out of the office here.
I was just saying, you get to see that because you come down to my office and you see the
yeah.
and all the stuff that's good.
Our 5-minute meeting, our 5-minute quick discussion. An hour later, I'm out the door. Okay. Okay. Finally, before we wrap up, just before we'll wrap this up here, where do you stand regarding owning fixed income right now? Back here, I remember 2021, you shortened the overall duration of our clients' bond portfolio to right around like 3 years. Now, that was the good news. We lowered the volatility, right? But,
Yeah.
the yields were below 2%.
Right.
As we sit here today, early in 2025, where's that sweet spot on duration, and what is the expected yield for both the US and Canadian fixed income portfolios?
So just kind of giving you a little history, as you said, we had shortened our duration. We actually were down around 2.5 back in 2021.
Yeah.
And then remember, that's when inflation took off. That's when interest rates.
That's when
And so it was a really good call on our part. We did a great job.
Yeah.
Again, not to, pat ourselves on the back, but again, we just looked at,
I think
again,
it was worth a pat on the back, Steve. We saved a lot of pain, if you ask me.
but we did, but what we do is, again, it's that churning, and we're looking for risk reward, and at that point, when interest rates were so low, remember, a 30-year Treasury bond was 2%.
Yeah.
Why take the risk for a 2% return when I can have almost no risk and get a 1.5% return? I mean, for
and we saw what happened to those long-term bonds, right? Negative.
Exactly. They just, it was, so we were looking for value. So in 2023, we started extending that duration out. So right now our durations are right around 4.5 to 5. I don't think we need to go any farther. We probably could. I think interest rates, when you look at the US and the Canadian interest rate yield curves, they're still relatively flat. We do have an upwardly sloping, but they're still relatively flat. And part of it is because the central banks haven't lowered rates as far as I think they will. Canada will probably be a little bit faster than the US, which they have been.
I think they will be for sure.
And believe me, if there's a tariff coming on, there's a lot of incentive to lower rates again. So the Canadian markets and the Canadian fixed income markets are going to have a much steeper, much more normalized yield curve. The US is getting there. It's just a little bit slower. So I don't think you're going to see, people always say, where are interest rates going? And we always say, well, interest rates are coming down, but you really have to explain that. What they're usually talking about is, what are short-term interest rates doing? What are Fed funds rates doing? What are the Canadian central bank rates doing? They're coming down. Once you get out into the past that immediate Fed funds rate and everything else, now you're talking about treasuries, both Canadian and US, and you're talking about their issuance of those securities. Well, the 5-year, the 10-year, the 30-year, they don't have to come down in interest rates. I mean, if we've got an economy that has a 2.5%, 3% inflation rate, and we've got it growing at 1, 2, 2.5%, rates where they are today is probably where they should be. They don't need to come down. And if the economy actually heats up significantly, I use a little Trump's rhetoric here. It's the greatest economy that's ever been, and we're going to have the best growth we've ever seen.
The golden era. The golden era. Like,
okay. If that happens, not that it will, but if it happens and we do get higher growth rates, which we can, again, lower regulatory burden, there's a lot of reasons why we could get faster growth than what we've had. If we get that, rates probably on those longer term interest, they're not going to come down. They may actually go up slightly because you've got this growing economy, you've got demand for it. So the intermediate to longer rates are probably where they're going to be, maybe a little higher, maybe a little bit below, but not a lot. So you're getting your best value at that 10 years to 5 to 10 year, with that steepest part of the slope is where you're getting your best value on the fixed income. And that's both Canada and the US. So the beauty is we're actually getting paid to own fixed income.
Exactly.
Again,
what do you think it's going to look like this coming year? What do you think it's going to look like this year?
I think it's probably going to be fairly similar to what it is today. I don't think there'll be a lot of change at the end of the day. I think there'll be some volatility around it. And I think news will affect it more than actual economic activity. If the economic activity comes in, what we think, which is a good economy, a growing, there's no reason for rates to come. The intermediate to long rates, there's no reason for them to come down.
You can still bring short rates 4.5%, 5% range would be realistic.
I do. I think that's where we're probably going to stay.
And that money that when we earn that money in our client's portfolio, we get to put in, for those who are not taking distributions, we're putting that money to work.
Exactly. And that's part of that rebalancing process where we build cash. Where's the best value? Is it equities or is it fixed income? And you put it to work there. And that's part of your rebalancing. Sometimes you don't have to sell anything to rebalance. You just accumulate enough cash that you can put the money where it needs to go to rebalance your portfolio.
Yeah. Okay, Steve, before we wrap up this episode, and I know we've probably gone a little bit longer than normal, but I think it was well worth it. Is there anything that we didn't cover that you want to address? I'm going to give you the last word, if you will.
I think that the only thing, my word of caution is to be patient, which the markets are not very patient. And we've seen that since October, November, with the Trump win, especially in the US, markets have gone crazy. Crazy, shouldn't use that term. The markets have gone up. They've been very excited. There's been exuberance over what's coming.
There's some volatility there in the midst of all of that, I will say.
Exactly. And so they're missing that it doesn't happen overnight. The market participants, investors got really excited that, oh, it's going to be lower taxes, it's going to be less regulation. It's a slim majority. We talked about this. It's a slim majority in the House of Representatives. If you get legislation passed, it's going to be very difficult. It's going to take negotiation. It's going to be butting heads. The media and the opposition will be saying lots of things. There'll be a PR campaign around it. It's not going to happen overnight. So I think better times are coming. I mean, we're already in them. I mean, it's the economy is doing well. It's going to continue to do well if we get better regulatory environment, and better meaning more business friendly. Now the other thing that goes along with that, and I was telling this to a client just yesterday, is don't assume that this new administration is going to just throw all the rules out the window and it's a free for all, and because that's what the opposition would love to paint. But he put Robert Kennedy Jr. in his cabinet. I mean, drug companies are going to be held to a very high standard, which they should be held to. We've already seen, red dye number 5. The FDA finally came out and banned it. Red dye number 5 is in everything. I mean, there's a real retooling that's going to happen. So it's not an administration that's just going to say, "Hey, do whatever you want." These are guys that they're going to hold people's feet to the fire. There's going to be accountability, but it's going to take some time. It's not the Wild West. They're not throwing, do whatever you want. This is going to be a far more disciplined administration than it was the last time he was in office. The people he's put into his cabinet are going to hold people accountable. But it takes time for this thing to happen. I think we're probably going to see some disappointment in the next month or two when they actually get down to negotiating and fighting and screaming and yelling, and the media, chiming in. So it's okay that there's going to be a little bit of volatility in the markets right now. Be ready for it. Be patient. The economy was moving along pretty well. It's going to continue to move along pretty well. That will bode well for the financial markets eventually, but we might have a few bumps in the road. So I'm just maybe tamping down the exuberance a little bit with my closing comments.
Okay, and on that note, on the closing comments, and great job, and thank you for those who hopefully stayed with us for the entire podcast. We talked at the very beginning of the episode about tariffs. Now, I'd kind of like to leave on that note too, if you don't mind. So in your view, what we said is that most likely that there are tariffs, we're probably looking at a 10%, and it will have a not dire impact on the Canadian economy. If there was a 25% tariff, it would be significant. And the good news, I would say, to add to all of this, is that you guys are watching this so closely that you'll be able to adjust if that were to take place.
Yeah, we would definitely be, again.
The odds we think are low, but if that were.
I work in a world of probability, and we assign probability to things. I think the probability of a 25% tariff is low. The probability of him using it as a negotiating stick is high. And the probability of a 10% tariff is fairly high, because he may do that across the board and then back him out as he wants to. I don't even know if that's the case, because again, what's really interesting is with the first 3 days and with all the executive orders, there were no tariffs included So that's telling us that while he's talked a big talk, he has people behind him that are in his ear saying, hey, if you're going to do something like this, you've got to do it right. It's got to be disciplined. It can't be just with emotional. And so my probability is high that the tariffs are a minimal impact on everybody, and especially the Canadians.
Well, I guess at some point during the year, we're going to have you back and do a review. Steve,
You're gonna take notes and then hold me.
well, it's
hold
too
me
late.
accountable
We're
for everything.
editorialized now. I mean, we've memorialized this conversation. It's there for the world to listen to. So, at some point between now and probably the fall, we'll circle back and see where we're at. So, Steve, thank you so much. I always enjoy our conversations. I appreciate you making time for us today.
All right, great seeing you again, and come on down to my office and we'll have our 1 hour,
another
5 minute
5-minute conversation. I look forward to bringing you the 3 Question Podcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive notification of when our latest episodes have been posted, please click on the notification bell. Lastly, to schedule an online consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.